time.
Hello and welcome to Bloomberg Quint Live. You're watching Trend Spotting. I'm Shraddha Babla. Good morning, Agam.
Good morning, Shraddha. I'm Agam Vakil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and their implications for investors. First, the headlines. Markets extend losses for the second straight day. The Nifty hovers around 10,650. Drug makers weigh on index while realty players extend support. Broader markets trade muted. And Lanco Infratech may be headed for liquidation after its lenders reject the highest offer made by Triveni Earth Movers. And JSW Energy falls the most since March 19th after the company reported an unexpected loss during the March quarter on the back of one-time loss. A simpler filing system, proposed cess on sugar are on the agenda at the GST Council meet today.
The benchmark indices are trading near the day's low at this point in time, led by the weakness in global stocks. 40 points taken off the Nifty index, 130 off on the Sensex. Three heavyweights responsible for at least half of Nifty's losses. You have ITC, Infosys and RIL. Those three are dragging the index lower. The mid-cap and the small-cap index, however, are faring much better, alternating between marginal gains and losses at this point in time. Some of the pharma names are under pressure. The metal index, I believe, has recovered from the day's low, so there's some upward movement in that metal index. The broader market breadth, however, remains equitably distributed between gainers and losers, so no specific trend, Agam. It looks like a very stock-specific market.
Right, absolutely. Of course, you know, both you and I were discussing how the mid-cap IT stocks have been faring. We've seen some pressure on Hexaware Technologies as well, and well, I was actually running a check on the number of mid-cap IT companies which have done well on a year-to-date basis, and then eventually, you know, how we've seen a little bit of correction coming in over the last three to 4 days. As you can see out there on your screen, mid-cap IT stocks have done extremely well over the year, barring a few, of course. But on the whole, it is only now in the last 1 week or so that we're looking at a little bit of correction in all these companies, and this is after we've started getting the earnings. The earnings have been good; they've been steady. But the real question is, how do they stack up with respect to what we have on the Bloomberg consensus and the kind of targets that we're looking at? And I noticed that all these companies have not only achieved the Bloomberg consensus targets, but also have moved way above those levels. And that's the reason why perhaps we're looking at a little bit of profit taking, some leveling coming through with respect to their valuations. So that's one reason I can imagine why we're seeing so much pressure on mid-cap IT companies today, Shraddha.
Akam, but 11% drop on Hexaware Technologies is because overall the numbers do seem in line with the Bloomberg consensus estimates. Is it the margin disappointment which is weighing on this? And in fact, even NIT Technologies was seeing a drop for the third straight day ahead of its number. So is it this margin disappointment of Hexaware Tech that could be rubbing off on NIT Tech?
Well, it's possible, and I'll tell you how the markets are viewing this particular phenomenon right now is that the valuations for mid-cap IT companies, which have historically always been much lower than the large-cap companies, have now taken over them over the last 6, 7, 8 months in terms of price-to-earnings ratio, and that by that I mean 1 year forward price-to-earnings ratio. Well, this is for the first time perhaps that we've seen some of these price-to-earnings ratios, for mid-cap IT companies, which are much more than the large-cap companies. And considering the fact that we've seen such a stark run in a lot of these companies, is the reason why we're looking at a large correction right now. And even in terms of earnings for Hexaware Technologies, Shraddha, we really aren't seeing too much. I mean, it's not out of sync. It's largely in line with Bloomberg consensus expectations. And there really hasn't been no surprise in terms of margins either. How NIT Technologies performs, well, we'll have to wait and watch. We are certainly expecting a robust quarter. It's already to a certain extent factored in. The question really is that are we in for a disappointment? That we'll come to know at 2 o'clock this afternoon.
All right, we'll watch out for all those IT earnings, but let's tell you what we have lined up on this earnings special of Trend Spotting today. First, we will decode the March quarter earnings for Orient Cement as we connect with the MD and CEO Deepak Khetrapal. And then we will get the highlights for the fourth quarter earnings for PNB Housing Finance as we connect with the MD Sanjay Gupta. And finally, we will connect with NH Bansali of Imami to get a fine print of their March quarter numbers. Okay. Orient Cement has reported a 21% decline in its March quarter profits, while the total income has dropped by about 4%. What were the key factors weighing on the company in the last quarter, and what does the road ahead for the company look like? Let's ask the Managing Director and Chief Executive Officer Deepak Khetrapal. Thank you for joining us, sir. Wanted to understand what is weighing on the EBITDA margins, and could the pressure on margins continue going forward as well, given the way petcoke prices have moved?
Well, just to get the numbers right and get the perspectives right, I don't think we've suffered a decline in EBITDA margins over last year's same quarter. In fact, there's a marginal improvement. At the EBITDA level, performance is slightly better. Now, what is looking worse is the net profit level, where obviously it's the tax provisions that we made. When you turn profit, last year we had losses. And this year we've turned back into profits. So obviously the taxation has hit us, and that's why the PAT level looks like it has eroded, but not at the EBITDA or the operating profit level at all. So that's just one part of the thing. The overall, I think, results, if we look at for the company in this quarter, we've actually done around 84% of capacity utilization, which I think is something that we can take a lot of satisfaction from. And the momentum in demand and the momentum in price actually that we are seeing going on from early April, that actually augurs quite well for the new financial year that we are now into. And we are looking forward to building a good year based on the demand momentum, one, and number two, the improvement in prices that we've seen in the recent few weeks.
Fair. So, could you tell us a little more about what's happening on the demand front, and when can we see the pace of volume growth pick up?
If you notice the volume growth that is being reported by the industry, it's obviously fairly robust. The only reason why our company has not reported volume growth only in Q4, rest of the year we've been reporting volume growth throughout the year. Q4, the only reason is because we are comparing it with the fourth quarter last year, in which we really had an outlier quarter when we utilized capacity of 87%. So obviously with 87% capacity utilization, there is not too much room for growth left for you. And but just clarifying, is the momentum in the demand in the market strong enough? Yes. Why did we not report last quarter growth over the previous year? Is purely because we had 87% utilization already. So that's the clarification for the industry and for the company.
Sir, the realizations were down on a sequential basis. Is there a possibility of further deceleration when it comes to realizations?
No, on the contrary, after prices remaining very soft in the fourth quarter, what we've actually seen is price improvement from early April. So as we speak, we seem to be back on track how we were in the first half of last financial year, which was much stronger. I mean, just to sort of clarify the picture, while the year as a whole we've closed at EBITDA per ton of nearly 560 rupees, if we look at purely the first half, our EBITDA per ton was close to 800 rupees. So the prices that we are seeing now are comparable to prices that we were seeing in the market last year, April. And that actually should improve our EBITDA per ton as we work now and go forward, assuming that the prices that have improved, they stay in the market.
All right, and if you can also talk to us about capacity utilization, which is at current levels, and also the acquisition of JP Associates assets has increased your capacity into what extent, sir?
Well, JP acquisition has not got fulfilled yet. We have a transaction. In fact, we are now awaiting the final confirmation that all the conditions precedent to the transaction are being met by the vendors. We still haven't got their confirmation. So those capacities are still not with us. That's one clarification. There is a long stop date to the transaction, which is actually end of May. So in the next few weeks, we'll have complete clarity on by when are we likely to get the conditions fulfilled by the vendors, and only then we can get into the business. But in terms of capacity utilization, as I said earlier, in the quarter that has ended 31st March, we had capacity utilization of around 84%. For the year as a whole, we are in the 73, 74% in that range. And currently, as we speak, this quarter also, I mean, although it's still less than 5 weeks, but we are seeing positive signs in terms of demand and our growth over last year same time. So it's too early to talk about the quarter as a whole. But yes, first 4 or 5 weeks, we seem to be definitely ahead of way ahead of last year.
Are we likely to see some sort of a moderation in debt levels going forward?
Obviously, when we say moderation in debt levels, one thing we have to understand is that the borrowing that we have on our books, which largely came for our new project that we commissioned about 2 years ago. On that, yes, a repayment program has started. But in the meantime, what we've done is, because we've had profits in this last financial year, and obviously if we look at the last year with the total EBITDA being at 325 crores and interest outflow of, let's say, about 130 crores, we obviously have close to 200 crores of the cash generation, which we have actually parked, obviously, some of the borrowings that we were making for working capital earlier, that we've not utilized. And as a result of that, if you take note, our overall financing costs in this year is lower than the previous year. So what we are right now doing is, although cash is accruing, but the capex that we are continuing with, we are not borrowing any more money. We are using our internal cash flows and also not utilizing our working capital facilities. So cash accrual from the profitability is helping our overall treasury, and that's why the financing cost is looking better than it did last year.
So just want to understand a little more about the South Indian market and where the demand for cement is actually coming from. Is it more from the affordable housing front or some of the metro projects of the state governments, or what? What are the demand supply dynamics right now, and where are these? Where could possibly the volume growth come from?
The volume growth, let's be honest, right now is largely coming from the push on the government-sponsored, government-funded projects. Road projects, we've all known about how much work is going on across the country. Plus, there are various pockets in the country, especially around our areas of operation, which include Andhra, Telangana, Karnataka, and Maharashtra. Irrigation projects, the affordable housing projects, the smart cities. So a lot of these projects are on, which are consuming a lot of cement. But we also are seeing steady demand from the housing segment in the semi-urban and rural areas of the country. While in the urban clusters, obviously the demand for cement is not much, because hardly any construction activity is there because of the overhang of inventory there. But in terms of semi-urban markets, rural market, independent house builders, and the government-sponsored projects are the main sources of demand that we're meeting today.
Okay, so we leave it at that. Thanks for joining us and giving us an update on the quarter's earnings as well as the outlook going ahead for Orient Cement. We will keep tracking more developments as far as the company is concerned, as well as the sector, of course. But just before I move on to our next conversation, I want to address what's happening in the markets. PC Jeweler is now up as much as 22% in today's day of trade, now inching back towards the mark of 150. You have it 148 to be precise for now, and Similarly, we have Hindustan Construction, which has come off days highs, however, still in the green by as much as nearly 7%. Good gains coming in HCC. This is largely on account of the gains that we've seen, especially on account of the earnings. Do remember the stock had taken a little bit of a beating in yesterday's day of trade because of the bad news coming in on the Lavasa front. Of course, that said, these are some of the stocks which are buzzing on the volumes. We also have a lot of traction in Ratan India Power. That's also about 8.5%. So we're looking at gains there, and Max India up and about as much as 5% right now.
All right, Agam, with that, let's move on to addressing the numbers for PNB Housing Finance, which reported a very strong quarter in March with a 50% growth coming in on assets under management. Also, the bottom line witnessed a 45% sort of a jump this time around. So what are the other key highlights of the quarter gone by? Let's ask the management. Joining us now is the Managing Director, Sanjay Gupta. Good morning, sir, and thank you very much for joining us. For how long do you think can the company continue with this sort of a growth trajectory of 50+%? And again, what would give you that kind of confidence on growth in such a competitive environment?
The growth rates are all, an outcome of the capacities that we are building across the country and the economic drivers. So if the external macro economy improves, certainly our growth rates can be sustained. And well, I keep saying for this question every time that our growth is actually related to the capacities that we build and execute and put them to economic use in the subsequent year. So last year, which is 17-18, we have added 21 more branches across 8 new locations. We have added 3 more underwriting hubs. We have done a lot of advancement on our technology, which has further strengthened our target operating model. And I think we can easily do about 1.7 to 1.7 times the industry averages when it comes to growth rate. And we can sustain ourselves and keep on delivering very good quality customer service and good quality portfolio for years to come now. So it's a very robust and a stable organization that we have built.
So housing loans are about 69% of your lending portfolio and non-housing is about 30%. How do you expect this mix to change over the next 1 or 2 years?
Well, in the medium term, that is about 8 to 12 quarters, our strategies are not going to change. We are going to be very consistent. And at a portfolio level, pure home loans, that means individual home loans, are going to be about 60%. 12% is going to be construction finance for residential units. So together about 70% is going to be housing. In the non-housing segment, 15% will be loan against property, and the remaining 15% will be equally divided between lease rental discounting, corporate term loans, and non-residential premises loans. And we have delivered this sort of a mix over the last 6 years, and we are very confident we can do it for in the medium term of, let's say, 8 to 10 quarters going forth.
Sure. Sir, but when it comes to the fourth quarter margins, they came in at 2.29% versus just 2.5% that you were able to do in the December ended quarter. Is this in any ways reflective of the pressure on yields, and what is the kind of range of spread that you would be comfortable with?
So the spread in quarter 3 was, I would say, an aberration, and that is why I had also given a little bit of a signal, because we did a huge amount of wholesale products in quarter 3. So what as a steady state one should expect is about 210 to 215 basis points of spread on the net interest margin or NIM. It will be around 305 basis points to 310 basis points. It is today at about 307 basis points. Our gross spread, which also includes our non-interest income or our fee income, will be around 340 bips. And our cost to income ratios are coming down now dramatically. Our OPEX to ATA is also coming down because the economies of scale are panning out. And I think that is the story on the profitability of this company is going to improve quarter on quarter, year on year from now onwards.
And with Tier 1 capital at 12.8% and fast capital consumption in FY18, when will you have to look at capital raising next?
Somewhere in the last quarter of calendar 2019 or the first quarter of 2020 is what we are estimating that we will have to go back to the capital market to raise ordinary equity. Till that time we have, because just remember there are going to be internal accruals also, and they are going to smarten up as we go quarter on quarter and year on year. So I think by that time our net worth would be about 7,500 crores to about 8,000 crores, and we will be easily be able to lever about 10 times, and with that portfolio size we can go to the capital markets in that 6 months window from, let's say, October of 2019 till March of 2020.
Also, what on the cost efficiencies? Could the cost to income ratio tread lower further from the current levels?
Well, in the last year we did pretty well. Our cost to income ratio came down by almost 3 percentage points. We are, because you have to also time all these ratios to your go-to market or your, I would say, the next capital raise. I think in the next 8 quarters or 2.5 years, our cost to income ratios should come down further to about 16% or 17%, and our OPEX to ATA should come down to about 56 to 60 bips, and hence our return on assets will grow from about 1.54 today we are sitting at to about 1.7, and we'll be levered at about 11 times, and we'll be making an ROE positive of 18%. Yes, it sounds very sort of easy, sort of an equation on a TV interview, but when you get down to working it, you have to really sweat it out to achieve these figures. But yes, those are my individual targets for the company.
So there have been various reports on your largest promoters, PNB, considering paring its stake, and even Carlyle having put a 10% stake on the block. Your thoughts on the prospects of a stake sale by some of these key shareholders?
You have put the toughest question at the end, and unfortunately, I mean, that's a shareholders' matter, and I cannot comment on it. We love our promoters, we love the other shareholders. We like them. We will like them to be there to enjoy this ride with us. But yes, if they have to, we can't do much about it. That's it.
Right. So you're saying that you haven't received any communication from either of them on their intention to sell stake?
As of now, I am not aware. I will be very frank. As of now, I'm not aware.
All right, so we leave it at that. Thanks a lot for joining us and giving us an update on the quarter gone by, and also what we can expect for the next few quarters. That said, let's move across to the other management which announced its earnings yesterday. And the March quarter has been soft for Emami, with profits declining by as much as 28%. But this is, of course, on a cash basis, because the company does give you earnings on cash and non-cash basis due to amortization on the Casing acquisition that they made a couple of years ago. But growth, on the other hand, has seen an uptick, and this is largely on account of the volumes that we saw move up by as much as 9%. To discuss the quarter gone by and take stock of what's happening in the upcoming quarter as well, we have the CEO on the phone line for finance and strategy, Mr. N.H. Bhansali. Mr. Bhansali, good morning and thanks for joining us. Let me just begin by asking you about what is behind this 9% volumes growth for this quarter, and to what extent does pricing have a part in terms of your overall revenues growth on a consolidated basis?
We have grown by 9% in terms of volume, while the overall growth is 12%. So that weight is good, and the growth has come from across the channels. While rural channels have grown higher than the others, but the general trade has also done good, and overall modern trade and all have supported. So from channel perspective, the growth has come from everywhere. And in terms of the brand also, if you look at the brands, the summer brands and other brands have also performed very well. So I think it is an all-round growth, and now it has started picking up. So I think if the momentum continues, you can see a good growth in the times to come.
So what plans have you laid out for the summer in terms of brands and product lines?
See, summer has already set in, and Navratna is an important brand and is doing good. So we have some brand extensions in Navratna. Navratna Eye Cool Talc with Dynamite variants. So some of the variants have been launched. Few new launches have also come. Apart from Navratna, in other categories also the new launches has come. Kind of hair color we have introduced. We have introduced Healthy Fairness cream in the Boro Plus also. In face washes, in the healthcare also some of the new launches. So the new launches and also growth from the core brands would drive the growth.
So it has been a challenging past few quarters for Kesh King, however. How are you dealing with intensifying competition even as Kesh King undergoes some changes internally?
So two aspects. While the overall the market has broadened because of a lot of traction from by the consumers, and also because of the increase in the competitive intensity across. So there has been a lot of buzz around this kind of a category, and while there had been challenges because of the disruption in the wholesale channel particularly, and increasing intensive competitive intensity. But I believe we are taking so many steps. We are investing behind the brands, and the product has been very superior to the products which are otherwise available in the market. So all taken together, we feel that going forward there will be a good growth which you can witness.
So with the investments lined up, can we expect some contraction in the return on capital?
Return on equity would still be good because if you look at the overall EBITDA margins are very high, and we will continue to drive those kind of margins despite investments behind the brand. So we expect no substantial change in the margin profile or the returns.
So now we understand you can't give us a guidance for FY19, but can you also at least give us an indication of what we can expect with respect to your revenues, volumes, and eventually margins as well?
What I can give you an indication about how the economy is performing, and if the economy is doing good, and also if the seasons are favoring, we are rightly positioned and poised to take an aggressive growth because of the subdued past and subdued performance in some of the quarters past because of obvious reasons of GST, demonetization, and many other factors. But now I think we are poised for a good growth, provided other factors also play a good role.
Right, Mr. Bhansali, thank you very much for joining us with the latest updates on this quarter. The stock, of course, continues to trade under pressure, down about 2.5% or so. But with that, let's go on to a special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up. Yash, what are the charts indicating today?
Well, thanks for that, Shraddha. The RSI on the charts of IGL has fallen below the mark of 30. Now, the stock has been under some selling pressure. It is down for a 7th consecutive trading session. Its longest losing streak since November 2015. The stock has given up on gains in excess of 10% in that period and has entered the oversold zones. Now, what is RSI? Basically, it is one of the technical indicators that traders use to identify overbought and oversold levels. Now, the premise is simple. When the RSI line, which is the one in white color, crosses the mark of 70, which is shown in red, it enters the overbought zone, and it indicates that the stock is overbought and that it could lead to a downward move. And similarly, when the RSI falls below the mark of 30, shown here in the green line, it enters into oversold levels, and the stock could see an upward move from here. Back to you.
Okay, so we will watch out for IGL and whether or not it does eventually move out of that particular oversold zone for now. Thanks, Yash, for giving us those details. But with that, it's a wrap on this edition of Trend Spotting. But don't go anywhere. Hot money is up next, so stay tuned in a Bloomberg Quint Live.